My name is Steve Myers, and I want to thank you for taking part in this exclusive Monday morning interview with Jim Rickards, the financial threat and asymmetric warfare advisor for both the Pentagon and CIA. These agencies, that include the CIA, FBI, Army, and Navy, they've already begun to estimate the impact of the fall of the dollar as the global reserve currency, and our reign as the world's leading superpower being annihilated in a way equivalent to the end of the British Empire post-World War II. And the endgame could be a nightmarish scenario where the world falls into an extended period of global anarchy. Jim Rickards fears he and his colleagues' warnings are being ignored by our political leaders and the Federal Reserve. And we're on the verge of entering the darkest economic period in our nation's history, one that will ignite a 25-year Great Depression. Today we're going to examine everything he's uncovered, because the bedlam could begin within the next 6 months, which is why every American should hear his warnings before it's too late. Jim Rickards, thank you for joining us.
It's my pleasure, Steve. Glad to be with you.
And after 9/11, you were tasked by the CIA with investigating potential insider trading that took place prior to the terrorist attacks. We've just covered a lot of these startling numbers, these signals of this coming Great Depression. Let me see if I can quickly put it all together. Nobody denies that we have a debt crisis in this country. But you're saying we can no longer grow our debt without causing our economy to aggressively slow down. We're barely above water now. So that's signal number one. Signal number two is this dangerous slowdown in our velocity of money. It's already plummeting to levels not witnessed since the Great Depression in the 1930s. Are there any other signals the intelligence community is monitoring that suggest this collapse is right around the corner?
There are, Steve. There are a lot of signals out there, and they're very, very troubling. One of the ones I'm watching closely, and I know people in the intelligence community focus on also because it covers so much ground. It's called the misery index. The misery index is when you take the unemployment rate and you take the inflation rate and add them together and then just sort of chart that. You look at the misery index today compared to the period of stagflation in the late 1970s and early 80s that Americans remember so well, it's actually worse. This can lead to social instability. Take this back to the Great Depression. The misery index in the Great Depression was at 27, but today it's at 32.89. Believe it or not, it's worse today than it was during the Great Depression. What happens as the Depression worsens? Businesses can't pay their debts. The bad losses fall on the banks ultimately fail. That's happened before. The Fed's there to bail out the banks. What happens when the Fed itself is in jeopardy?
Based on these signals you've been tracking, the Federal Reserve is going to fail?
The Federal Reserve actually in some ways already has failed. I spoke to a member of the Board of Governors of the Federal Reserve, and I said, you know, I think the Fed's insolvent on a mark-to-market basis, and this governor first resisted, said, no, we're not. But I pressed her a little bit harder, and she said, well, maybe. And then I just looked at her, and she said, well, we are, but it doesn't matter. In other words, here's a governor of the Federal Reserve admitting to me privately that the Federal Reserve is insolvent, but said, you know, it doesn't matter because central banks don't need capital. Well, I'm going to suggest that central banks do need capital. Look at this chart. What it shows you is that the Fed has increased its capital. It's currently about $56 billion. That sounds good. You say, gee, $56 billion is a lot of money. That's a pretty good capital base. But that's not the whole story. You have to compare the capital to the balance sheet. How much in the way of assets and liabilities is that amount of capital supporting? When you look at that, it's a much scarier picture because the actual liabilities, or debt, if you will, in the Fed's books are $4.3 trillion. So you've got $4.3 trillion sitting on this little skinny capital base of $56 billion. That's very unstable. Prior to 2008, the leverage was about 22 to 1, meaning they had $22 of debt on their books for every $1 of capital. Today, that leverage is 77 to 1. So yes, the capital has increased, but the debt and the liabilities have increased much more.
Your warnings haven't gone completely ignored. In the budget he presented this year, Senator Rand Paul cited your work and how we've driven our economy to the edge of a Roman Empire-like collapse. In fact, we have footage of Senator Paul instructing Americans to listen to your warnings.
Jim Rickards, author of Currency Wars, notes, the Fed is insolvent on a mark-to-market basis. The Fed has wiped out its capital on a mark-to-market basis. Of course, the Fed carries these notes on its balance sheet at cost and does not mark them down to market. But if they did, they would be broke.